Hey guys, what's up? Stock Retail coming back to you. Happy weekend to you. Happy post earnings. Happy Dune opening, Dune 2. A lot of good things going on, lots to celebrate. I'm just going to do my usual deep dive on earnings. There's something I had started a few years ago. I want to say in 2021. You could find it on Reddit in particular. That's where I'd kind of started it in the first place. But I got really sick of some of the FUD out there. In fact, we saw that this week, right? Like people having headlines that didn't really match up with the results that we saw in the earnings. And if you've been in AMC for a while, I've been here since the beginning of 21. You're used to that, but that doesn't mean it's okay, right? And so I had started this scorecard I called the FUD Buster all the way back then, and I've just continued it ever since. For me, it's kind of like performance management. In fact, that's a role I had for a while at the large company I've referenced that I worked at a few times. So performance management, if you kind of keep measuring the same things over time, you can get a real pulse of the business and know how it's going. So I'm trying to show you guys, if you're new to this channel, apologies to people who've been around, probably tired of me saying it, but I have two masters in business. I worked at a Dow Jones company for 21 years. So I want to just show you, continue to show a little bit of how people look at the business. And all of this I'm pulling from the income statement, I'm pulling from the balance sheet, so you could easily fact check everything I'm going to share with you. I just happen to have been pulling this for all these years and kept it in a spreadsheet all this time. So now it's like this nice repository of information, and I love to share it with you guys. I'm going to try to start high level, share a couple high level points that are going to help us. Then I'm going to do that deep dive. I know I'm going to just be real. I'm going to lose some people when I do the deep dive. Some people don't want to see that level of information, but I am going to end pulling back up and pointing to what's ahead. So if you're one of those people who isn't here for the deep dive, then I don't know. That'll help you know where to fast forward. Um, Otherwise, I'd love for people to stay with me on this because the more you get yourself educated on what's really going on and what's actually in the results. I'm just sharing hardcore results today. No speculation. No me talking about tokens and theories on Bitcoin and all that stuff today. Just going to look at the state of the business. So mentioned I'm going to give you kind of a high level view first. And what I'm going to do actually, if you were to go way back on my first YouTubes, I think those were fall of 2022, I was presenting a case with the financials that AMC did not need the box office to get to pre pandemic levels to be profitable. I presented that case clear back, I think, September of 2022. And so it was really I don't know, validating, really exciting for me to hear Adam and the team say that so publicly and so loudly this earnings release. If you listened to the call, you heard him say multiple times, and I believe I remember we heard Sean Goodman say it as well. But for sure, Adam said we'll be profitable even if the box office doesn't get to pre-pandemic levels. And that's not to say it won't. I see 2025 and 2026, we're going to have, a massive box office. And it was nice to hear the team say that as well. That's something else I had pointed you to in past videos. But I want to show you a little bit of, okay, why is he saying that? And that's going to be high level. That'll be kind of nice and easy to digest, some visuals on why he and I have been saying we don't need full on pre-pandemic box office levels for profitability. And the reason, by the way, that I started saying that so long ago is that is sort of a FUD killer as well. One of the FUD items was, oh, look at how low the box office is compared to pre-pandemic. You guys are screwed. That kind of language we were getting from a lot of shorts. And I was showing you, years ago, hey, don't worry, because Adam and team have managed this business well and have set us up to be far more profitable than we were pre-pandemic. All right, then I'm going to do that deep dive. I'll go through the scorecard. We'll kind of think of it like a state of the union, like a state of the business on AMC. And that one, I just hold myself to quarter in, quarter out so that we can be real objective. The numbers don't lie. We're going to let the numbers tell us a story. Are we kind of green, yellow, red light is what I do with that one. So that's why I kind of call it a scorecard. And then I will show you what's coming and just kind of jokingly here saying prepare your shirts because honestly, I'm going to show you a view actually of our next Q4, what's coming later this year. And even as I prepared it, I was getting jacked. So prepare your shirts for that one. All right, so I'm going to show you a few views of some key parts of the business and why it's actually better now than pre-COVID. And if you want to go back, look for a couple videos clear back in 2022 of like, is AMC's business sort of better now than pre-COVID? There's a few different ones about that. And, that actually holds up. It's still the same case. It's still the same thesis. I got sort of trolled, I don't know, a year plus ago about like, why are you so focused on fundamentals? I'm here for the squeeze. And one of the things I've always done is I think it's FUD fighting personally, because if you can see that the fundamentals of this business are turning it into a profitable business, that's the key, right? Can AMC actually survive and then thrive? Adams used that language. Um, so I'm taking that one from him. And that really has been sort of the spirit of what I've been sharing with you for a few years, of showing you that AMC was going to survive and then thrive. He's just put language to it, and I love that. And so the point is, if you can see in the fundamentals that this is going to be a healthy business, then you know that the shorts days are numbered. And you guys kind of know that. You've been here long enough, you know we're going to win. But I love proving it and showing it to you, and kind of laying down receipts so that you can see, frankly, how sort of fraudulent and manipulative the entire financial media and the financial complex is. And so we can all be sort of waking up to that. Because again, the numbers don't lie, they tell a story. So here you go. Let's look at a couple things. This is just a progress check first, and then I'm going to show you all that sort of versus pre-pandemic. You can look, you can see here, bottom left, this is cash over time. So this is kind of how, obviously we're going to need cash to survive, right? So for a while it was because of the lockdowns. Now we're having to survive kind of storm number 2, but thankfully a much smaller storm versus the lockdowns. We got to get through the strike blip. You've heard me talk about that in a few videos. Go back in particular to a forecast video I did kind of at the end of October, beginning of November last year, that really spelled out how long the strike would last, what the impact would be to us, and when we kind of return to some really, really awesome results. And we do. We are going to return to those awesome results. So you can see all the way back to, this is the end of 2020. That's the beginning of this chart. We were at kind of the lowest we've been in a long time on cash at the end of 2020. But then you can see, Adam had built up a war chest to survive a lot of things going on. I want you to see actually these two charts in relationship. Yes, our cash has gone down significantly over time, but also notice our debt has been going down over time. So you can just clearly connect those two lines. We're paying off debt, and a lot of that has come from cash to pay off the debt. Yes, there's been some cash burn from time to time, but you also know, if you've been around, Q2 and Q3 of this year were profitable, and we had positive free cash flow, which was amazing. I was really celebrating that. So that's where you get this little jump into Q3. Our cash had gone up. That wasn't really from stock sales as much as we just had a positive quarter. So that was nice to see. We had positive cash flow. And then that the results we just got in Q4, there was some stock sales, dilution, you can call that, right? We built up the war chest again to now survive the strike blip. So you just see cash has been going well at the same time. And by the way, then you can see over this sort of 3 years that cash is actually up from 3 years ago. Meanwhile, in those same 3 years, look at what's been happening with debt. So just at a really simple high level to say, hey, we've paid off a ton of debt and we actually have more cash than we had then. That's good, right? I like that. So the other thing you ought to know, Adam has started to say, I think he started saying this 2 or 3 quarters ago, and it was something I had noticed as well. And I think I had published it either on Twitter or YouTube, or maybe both. And so we kind of were starting to say that about the same time as well, was our debt is actually lower than pre-COVID. So I've drawn this line here. At the end of 2019, AMC had about $4.9 billion of debt. And now we're at about $4.5 billion. So kind of, let's call it about 10% lower debt now than even pre-pandemic. And if you start to see the other metrics on this business, you're going to say, well, wait a second. Almost everything, again, is better than pre-pandemic. So here you go. Let's look at rent. One of the things I had shown you in those videos way back in the fall of 2022, it was kind of a tear apart of the business model to say, all right, what does this look like? Where is AMC going? And the point I really laid out back then was AMC has a very high fixed cost business model. What I mean by that is, let's say you've got your rent, and that's why I'm showing you rent here. Let's say you just were a really small time theater operator, you had one theater, okay? And so you have your rent, and your rent on that theater is the same month in, month out, let's just say. And 1 month you get to show one movie, and the next month you get to show, let's say, 200 movies. Well, it's pretty obvious the more movies you show, the more profit you're going to have. And you're paying the same rent, whether you show one movie or 200 movies. So to your benefit, as you start to have more product to sell, let's say, because that rent isn't going up. with the movie revenue you're bringing in. So when you have a fixed cost model and you start increasing your revenues, what's really great is you're going to see, in business terms, you'd kind of say the top line is going to grow faster than your expenses. So your revenues are going to grow faster than your expenses because some of these expenses, that's why it's called fixed. They're just set. They're fixed. They don't go up. And so the fact that AMC has a heavy fixed cost model, yet has more movies coming, and in the meantime has implemented things like popcorn and distribution and some other things, there is going to be a time where AMC is going to be highly profitable, and there's going to be some people out in the world who are going to say, whoa, who saw that coming? And you're all going to say, well, we did for years, and we tried to tell you. So it's there. It's pretty clear. This is going to be a Harvard case study someday. For those of you who kind of are MBAs, you kind of get what I'm saying. So you can see 2019, that's the kind of orange circle at the top. Those are the 4 quarters right there. So you can kind of see the zone I've circled. Rent was kind of north of 240 million a quarter. And then you can kind of see we've lived in this sort of 220 to 225 zone in quite a few quarters, like all of the last 3 quarters, 1, 2, 3 here. So we're kind of south of 225. We used to be north of 240. So we're saving 15 to 20 million dollars a quarter. So we're somewhere in the zone of like 70 to 80 million dollars a year in less expenses than we had. Now, some of that is because we closed some properties. But what you'd understand if like let's say a savvy business person would understand if any of those properties were kind of let's say margin drainers, they were kind of losing money, then overall that's a big benefit too. So you've heard Adam talk about how the company's more efficient these days. That is part of it. Our rent is down, this big fixed cost is down, and so that goes straight to the bottom line because it's a reduction in expenses. All right, better than pre-pandemic. Next item, food and beverage per patron. So you can see look down here at a bunch of quarters in 2018 and 2019. Now this skips to 2021 because back in the day I wanted to squeeze this chart and not make it have too many quarters in it. But you can see in general from pre-pandemic down here to now, we have jumped radically. As a percent, that is huge. I mean, look at this. This was like, I don't know, $4.75 a person. And now we're, I think this last quarter was like $7.13. Huge growth on the amount of spending on food and beverage per person. And so the team has done a really great job sort of diversifying the menu. Yes, there's been some price raises, but in some cases it's just, addition of like the McGuffin's bar in some locations. And just, I know like my family, there's a few food items we really like there. The pretzel bites and the flatbread pizza and some other things. Those sliders are awesome. So just exciting to see that when people come, they're spending more money. And so again, this points you to think about the future. When the strike blip is over, when there are more movies and more people come, and they're spending more per person, and you're paying less rent, that is a very profitable proposition. So good things are coming. All right, so how about better than pre-pandemic total money per person? Same kind of idea. This includes the food and beverage, but now you also get in some other revenue. You get in, of course, the ticket sales. And so you can see total revenue per person. We were, I don't know, around $15 a person, and now we're approaching $21.50 a person. So that is significant growth as a percent, and even just in terms of hard dollars. When people come, they're spending a lot more money on the movie itself, on the merchandise, on the food and beverage. So there's a real movie culture, I think, that has developed, and Adam and team have been kind of taking advantage of that. And so again, when more movies come, so you can just really look forward to the whole thesis all the way along was who can stick around longer, shorts or longs, right? And that is also why I am so loud, so consistent now, 3 years of consistency, to say you need to understand this business so that you can have the confidence to know, all right, we're not going bankrupt. Therefore, effectively, we can wait an infinite amount of time because we're going to be making profits. Now, don't worry, that's not at all what I'm saying in terms of the timing of the squeeze. This is not a squeeze video today. I am here for the squeeze. I believe in the squeeze. But what just gives me confidence and lets me, just accumulate more shares whenever I'm able to, you need to do what's right for you, but that's something I want to do for me, is I know we're going to win, right? So that's why I say that so confidently, because the numbers are telling me where we're going. All right, so revenue per movie also, you can see we're way above pre-pandemic. Sort of here's kind of 2018, 2019, and you can see, of course, we had the lockdown, so that's why this dip here. But overall revenue per movie, we're way up. So it just tells the story again. When we get more movies, we are going to be making a lot of money. But now I want you to know kind of what happened to our. By the way, on all these slides, if you've been looking at these little dotted lines, these are just trend lines. You can see it's like a polynomial. I'm not going to get into that, but it's just sort of showing you generally the direction we're going, and you can use those in Excel to kind of predict the future. They're not like super sophisticated, but just if you're wondering what that is, that's a trend line. I'm going to show you the strike impact. In fact, why don't we jump to that? And so I want you to understand, I told you this was coming last fall, and what I really want you to take away, in fact, I'm going to click a bunch, apologies for that, but think about the cash buildup we just had. And I told you I respected and understood why Adam was selling those shares this last winter, and that he was preparing for the strike blip ahead. And so you see, here's the most recent quarter in terms of AMC's revenue per movie. And what happened really, I'll just skip to that, you had Dune 2, you had Ghostbusters, you had Craven, all the really big movies had moved out of the quarter. And now what's great is we're starting to see some of those, right? Dune, by all measures, is starting off really, really well. I loved seeing the sort of launch date revenues yesterday. If you haven't seen those, go look that up. It was really great. I want to say kind of 32.5 million domestic, sort of including previews. Really great first day. I want to say that's also maybe almost double the first Dune movie. So that franchise is really taking off. It's doing well. There's a lot of excitement there. We even had the popcorn buckets on Saturday Night Live. There's just good things happening, right? But there was a strike impact in Q4. And by the way, Q1, I'm just going to be honest with you, the strike impact is even deeper than it was in Q4. But as Adam said on the call, and as I've told you in videos, from here on, we start to get better and better and better. So you're going to look ahead to a strike impact Q1 results as well. And I'm sorry to say that, but that's real. But again, you're hearing my bullishness come through time and again because I know what's in the future, and I am a future-facing type of person. And honestly, normally Wall Street is too. Wall Street tends to price stocks 6 to 9 months out. Obviously, they're being very stubborn about us, and we all know why. But eventually, we're going to make them bow the knee. I really, really believe that. But I want you to just see this Q4 impact on the right. And the reason I'm highlighting that is you can understand Adam saw that coming, and he built up the cash to deal with it. So those who have been kind of whining and yelling and being really negative about dilution are not understanding. And in fact, if I could just click a bunch again, I'm going to underline something Adam said. Look at this low point in cash here, and think about the debt we've been paying off as well. And this was about 500 million a couple quarters ago. And right now we're at about, now I include here, this isn't just cash on hand. This also includes restricted cash. So it's kind of a slightly higher than just the cash on hand. But anyway, however you want to measure it, let's say we had roughly 900 million. Had he not diluted, think about how much he brought in and this company's ability to operate if it didn't have that cash. So part of us winning and beating the shorts is, well, we better not go bankrupt, right? We don't beat the shorts if we go bankrupt. You lose all your shares, guys. So you can be disappointed. I can understand that. And the strike caused that. And I'm pretty annoyed with Hollywood at the timing of that strike. Look, I supported the writers. I supported the actors. I felt the studios were being too greedy. But I think everyone was a little bit short-sighted and should have waited about a year to do that. I don't know. That's just my point of view. But also, it's their livelihood. I understand that. So I'm saying that with respect. And the great news is we're still going to win. So I guess I'll just leave it there. But there was a strike impact, and that continues. You need to see that. You need to understand why he's doing what he did. All right, so here's the deep dive. So if you're just going to fast forward to the next part with the high level, go ahead. But I would love for you to stick around and kind of get educated and really understand where our business is at. All right, so I'm going to go through these one at a time and sort of trust you to walk along with me. So this is the same scorecard I've done for years. I have not changed it. Sometimes I do quarter over quarter. Sometimes I do year over year. Typically, I do the year over year for the first quarter because Q1 just is kind of always the smallest quarter of the year. It just has to do with a little bit of seasonality with movies. I did do year over year this time as well, and that was because of the strike impact. And also because Q3 was just such a bang out quarter. Like it was amazing. You guys know that. We had kind of record levels of revenues and we had profits, we had free cash flow, a lot of really good things. Well, that's just not a good quarter to compare to right now. So year over year still tells you the direction of how we're going. And so that it's clear too, I'm not cherry picking. That is comparing the same quarter to the same quarter. And all right, from last year to now, where have we gone? So let's walk through that. All right, so one thing I measure, some of this is from the balance sheet and some of this is from the income statement. So you see a mix of it. And that is what in business you kind of call a balanced scorecard. You're trying to look at a lot of different pieces of the business. And it's the reason it's kind of a red, yellow, green light is, you've got these flashing indicators of how are different parts doing and how do we feel about that. So good news is you can see a lot of green on here. All right, so current assets. So that is basically our liquidity. I add in there more than just our cash. You've got a few other things like accounts receivable. But our total current assets is 1.2 billion, and that is $300 million higher than this time last year. So from last year to this year, we've paid off a lot of debt. I'm going to talk about that a little bit. And our cash is actually higher, even though we have a lower debt. So that to me is green. That's a win. Nice job, team. You can see that's a full third above last year. And I guess I've got that number here, the $569 million of debt paid over the last year, while we still have more, we're more liquid than we were last year. And by the way, the reason we're measuring liquidity, again, is to put this in Shorty's face. That's why I called this the FUD Buster. They want you to believe you guys are in trouble, you can't read a balance sheet, you can't read an income statement, you're going to go bankrupt. Baloney. Our liquidity is better now than it was a year ago while we have less debt. I'm feeling good. All right, attendance is up year over year, roughly matching the box office. So box office growth domestically was, I think, about 5% as well. And you can see where the attendance was coming from. So a little bit up in the U.S. I think some of that was also, of course, driven by our market share gains with Taylor and Beyonce. That was good. Up 8% internationally. And here's the thing that I want you to see. This growth is actually better even than what these numbers say. So look at the little note at the bottom of this one. In business, sometimes you want to look at comp growth. What that means is I would look at, I don't know, let's say a Boston property versus that same Boston property at the same time last year. That's a comparable, that's a comp. I'm looking at the same place versus the same place last year and did I grow? So the thing is, if you looked at just the properties we had at this time last year and you looked at the properties we have now, you would see actually better growth than this in terms of attendance. And Adam talked about that in the call. We had some really great market share gains due to Taylor and Beyonce, and I think then some spillover of some of those people coming back to AMC theaters. Well, remember though, in that same amount of time, we've closed some theaters. So our attendance at those properties went to zero. And so that's kind of dragging on our attendance growth. So if you took out all the properties you closed and you only looked at what's called comps, I know for a fact, just because I can just do the logic on the math here, that at our same locations we used to have, we grew by more than this. So I'm sure that at our properties we owned last year versus this year, we're growing our attendance faster than the box office. And then it was dragged back down because we closed some properties. But remember, when our team is closing properties, I think they've got a lot of wisdom and sound management, and they're closing properties that we're not really making money on. So I trust them on that, and I'm glad for them driving profitability in the business. That's smart of them. So I just want you to know, that's why this is green also, that we, in spite of closing properties, we grew our attendance. That's great. All right, so on food and beverage, you can see we're up 11% on total revenue. So net revenue, that means I can see in the income statement, I can see both the food and beverage revenue and I can see the food and beverage costs. And so I take the costs out because way early when we saw food and beverage revenue growing fast, one of the things the shorts would say is, yeah, but that's because of inflation and you've got inflation on your costs too, so you're not really making more money. So what I'm always looking at with you is, are we actually making more money on food and beverage? And that's why this is a net revenue number. So net, you can see we went up. We did indeed make more money on food and beverage than last year. Now, I also measure the margin. That's telling you, are our costs going up faster than our revenue or not? So you can see we lost just a half a point of margin, but overall we made $30 million more than last year at this time. So in finance, you look at something called gross margin percent, but you also look at gross margin dollars. We increased our gross margin dollars by $30 million. So in other words, we added $30 million to the business versus the same quarter last year. That's awesome. You can also see I'm showing you this little footnote. We're up 7% per patron year over year. So just really good stuff there. Continues to grow. Love it. All right, admissions. How are we doing there? So we're just really looking at the core of our business. Admissions is up $53 million versus the same quarter last year. You can see that's up 10%, so we outpaced the box office. Box office was up 5%, but our ticket sales were up 10%. So great. Well, that's coming from some price increases. You can see at the bottom, basically 50 cents a ticket, which was a 5% growth. And I think a lot of that also had to do with Taylor and Beyonce. Remember, those tickets, what was Taylor's, like 1989, I think, kind of in honor of her birthday for adults. So those tickets were a little more expensive than a normal movie and added to our revenue. But hey, that's great. I mean, you saw how excited people were to go to that. So if there's demand, awesome. Bring in the revenue. Let's do it. So yeah, just good news there. Green on that. Another thing I look at, so now we're back to the balance sheet, and this is just kind of about the balance sheet health. What I want to see, I'd love to see our liabilities going down and our assets as a percent of liabilities kind of growing. You want basically your assets to be up and your liabilities to be down in a way. So we, year over year again, in this year of management and in this year of even facing the strikes, how did the team do? Well, they have improved us quite a bit, 7%. So last year at this time, assets to liabilities was 77.7%. Now it's 83.4%. So our liabilities have gone down more than our assets in effect. Or in some cases, our assets, can have gone up. But so that ratio has improved. They're taking us in the right direction. So you just continue to see all of these core business items moving in the right direction year over year. Operating expenses as a percent of revenue. So this is kind of an efficiency metric I'm looking at. Now, I mentioned to you guys, we've got a lot of fixed costs, but there are variable costs too. Like you've got to pay the electric bill. If you're open, I saw last night, I think there was a Dune 2 showing at one of the theaters. I think I saw Cat Striker posted like there was like a 3 a.m. showing that was sold out, which is amazing. I'm so happy about that. Like you can almost hear me kind of giggling over here because that's just awesome to see. Well, if you're open that late, whether you're running the heater or in the summer, perhaps the air conditioner, if people, not to be silly, but if people are flushing the toilet, the lights are on, it just costs money. You've got to pay your workers. So there are expenses you have to operating. And as we get more movies, some of those will go up. We do have some variable costs. But you can see year over year, our operating expense as a percent of revenue has improved from 94% down to 91%. And I want you to know a couple things. In Q3, we were actually quite a bit better than this. And that's because we had more movies. And I told you about that fixed cost model. And so we had, I don't know, we were like in the low 80s or something in Q3. And this is a number I'm going to show you. Eventually, I'll chart this because when we get even just to this Q4 and as we get to 2025, this number is going to start to be really, really pretty. You're going to want to look at this number and just stare at it and kind of flirt with it. Not to be weird. I guess that is weird, but it's just going to be a really joy-inducing number because you're going to see us become really profitable. That's what we're looking at here, is the cost of operating the business going down versus the revenues you're bringing in as a percent. And so we've improved year over year, even though we had the strikes. And I just showed you, there's some pretty material impact from the strikes. Material is just a word you kind of use in finance. It just means, is it worth talking about? Is it a big deal? Is this something we should measure and show and talk about? So there were definitely material impacts from the strikes. This number would have been a lot better. And so that is not a management issue also. That's the other thing. And that's why I highlight that so much. And it's a one-time event in a way. It's like a 9-month event. We're going to live through it. It's not like a single day or anything. But once it's done, it's done. That's why I call that a blip or a one-time event. It's not part of our ongoing business model. And so it gives me confidence as an investor in our future. Now, free cash flow, you can see that's a red item. I've said many times, I'm going to be objective here. I'm going to let the numbers grade us so that I am not, I don't want to FUD you. I want to give you the truth. So last quarter, we had positive free cash flow. I celebrated that very loudly. I was very excited about that. This is a very important metric in finance. And we did have a negative free cash flow. But again, that is significantly impacted by the strikes. But then also, and here's sort of a sneaky positive in the middle of this. And I don't mean to spin, I really mean this genuinely. We expanded popcorn to Amazon, to Kroger, Publix. Remember also that we kind of started this distribution business from nothing. And I didn't even put on here, we also implemented candy. All of those, I'm going to assume, now, assumption here, hear that word, right? This is me guessing at the numbers. I wish I had looked at this. Well, actually, I guess you don't really get this before the earnings call. I kind of wish someone had been able to ask this in the earnings call so Adam could illuminate us on this. But I'm just going to tell you, I believe, with just my gut and my history in business, that it took some money to roll out popcorn wider, to ramp up this distribution business, and the candy. And I think we've just got some timing issues with our cash flows, timing and payments. I'm actually going to show you that in the next box here in a second. So it does not concern me, because what that actually means down the road is if there's what you call an initial outlay, like an investment up front, later on down the road that pays back. And so we'll start to see this turn around. In particular, this is really going to be dependent on the box office growth that we're going to see. But even for popcorn distribution and candy, now that the rollout is complete in some ways, we'll start to probably see some returns on that. And you'll see kind of this timing of payments that I say at the bottom here. Let's look at the next box, and this sort of proves my point. You can see one of the things I've tracked this whole few years is accounts payable versus accounts receivable. I'll explain that again real quick here. Some of you have heard me explain it before. Just think of it as what you have going out the door versus what you have coming in the door. Accounts payable is IOU. And just, think about if you went to your friend and said, hey, could I wait 30 days to pay you? And you had another friend who you said, hey, could you give me the cash right now? Well, now the cash gets to sit on your side. So if accounts payable is I get to wait to send cash out of my account, accounts receivable is I am waiting to get cash into my account. So if you can get accounts receivable turning around faster, bringing in cash faster, and you can make accounts payable kind of stall a little bit, or you can call it float in finance, you can sort of time keeping cash on your side. And it's just nice to have the cash on your side, right? So generally, I'd like to see accounts payable grow and accounts receivable shrink, just to have cash on my side. It's not, there's like terms of payment. You can't get into like gaming the system. Otherwise, you could get in some trouble. And so, I'm trusting the team to manage this with integrity, but there are things you can do in ethical ways to try to just manage your cash flow. And so I'm seeing that you can see accounts payable is down, which means more of our cash went out, and accounts receivable is up, which means we're waiting for that cash. So that's a 47 million. You can add those two up. That's kind of a $47 million swing. Well, look at our free cash flow was a negative 44. So, just year over year, had we been able to manage that a little bit, we might have been closer to having better free cash flow. Those don't tie one for one. So I'm being a little misleading how I'm saying that, but it's close. And so I do believe, because of the timing, in particular that accounts receivable, how much that's up. I'm wondering, for example, are we waiting on some of the distribution checks? Are the other theaters who showed Taylor and Beyonce, maybe they still owe us some money? It could be something like that. I'm making that up. It could have to do with popcorn or candy as well. So there's just a few things like that perhaps hit us, and that's just kind of a timing blip, but I'm not too concerned about that. Okay, moving on. So our net loss, just the bottom line, that's always going to matter. Let's never forget that. You can see, yes, we lost money this quarter. Now remember, I showed you in another video all about non-cash expenses. A lot of that was non-cash expenses, which is why you saw positive EBITDA. You get impairment, you get, there's this NCMI non-cash expense, there's depreciation and amortization. A lot of these things that hit the bottom line in earnings are not cash going out the door. And so I think our actual cash burn was maybe 78 million, or if you look at the cash burn from operations was basically zero. So those are two different numbers you can look at. So we did lose money, but notice year over year, in spite of the strike again, we improved by $100 million on the bottom line. almost a 40% improvement. And that's in spite of both the strike and then expanding the popcorn and the distribution and adding candy, which there's a cost to that, as I just discussed. So that is why that's green. Yes, we had a loss, but you can chalk that up mostly to the strike and to investments, and I am not concerned on the go forward view. All right, so bottom line, a few notes here at the bottom. Since 2020, debt is down about $1 billion. Like we're almost to $1 billion versus kind of the end of 2020. Cash, in the meantime, in that same sort of span of time, is up 600 million. So kind of add those. Even though we've had 900 million going out the door to pay down debt, we're up 600 million on cash. And yes, there's been dilution, Gasparino and others, and you can talk about that all you want. But hey, if I sacrifice a pawn to take your king, I'm down. So we're going to win. I'm pleased with Adam for not allowing the shareholders to take a bath. We have not gone bankrupt, and we will not. And so you can see that in the numbers. All right, free cash flow and AP versus AR, just talked about all that. So those are watch items. And we'll just kind of see if I'm right. Is that due to the investment and the timing? And of course it is due to the strike blip. That's pretty obvious, but that also means in the future we kind of get a return on investment from some of those investments. Equity sales, that's dilution, have prepared the company for strike impacts. They bought us time, right? Adam has made sure we have the runway to take off. I've said that over and over again, and I'll say it until we win. Growth outpaced the box office. That's great. That shows me good management. If you can, outpace your industry, basically, then your management team is doing something above and beyond the rest of the industry. The future, I believe, will reveal significant efficiencies. Partly portfolio management, right? So we've taken out some of those sort of losing properties. We've reduced debt. That is going to reduce debt payments. And we have a lot of non-box office items now. Like we have the popcorn, we have distribution, that we have candy. Maybe we're going to have beer and wine. So we're going to have things that aren't wholly dependent on the box office itself. We have these other lines of business. All right, so that is enough of the really deep dive. Kind of go back through that. I know I just said a lot of numbers thrown at you. I don't know, play me on half speed and go through that and take notes or something. I want you to turn your attention now to just, this is the part you needed to prepare your shirts for. I'm going to show you what's coming at the end of this year, all in Q4 of this year. We are going to get Gladiator 2. Now, you know that's going to be huge, and I'm crazy excited for that. We are going to get Sonic 3. Go back and look at how big Sonic 2 was, and think about the growth of franchises over time, and just how neat the story's going to be with Shadow coming and all that stuff. So that's going to be a big one. For me, I completely geeked out, I don't know, a year and a half ago or so. You can even find a YouTube video. The day I found out that Lord of the Rings movie was coming, The War of the Rohirrim. It's not directly out of the books. It's kind of its own standalone story. In some ways, I think it's a prequel to, it's sort of the story of, the Riders of Rohan and that whole nation. And man, I'm excited about that one. So my inner nerd is coming out. I cannot wait for that one. And if you have any awareness of how big the Lord of the Rings movies have been. Now, this is an anime movie. It's a cartoon. But gosh, I think it's going to be huge. Just look at how, Across the Spider-Verse, the Miles Morales cartoons have done for Spider-Man. I am really excited about this movie. Venom 3, those movies are all huge. That is also, now all of these are in the same quarter. Now think about with the strike impact, how we were in Q4. Taylor was awesome, but that was the biggest movie of the quarter. And love her. That movie was huge. She saved us for the quarter, but that was nowhere near kind of a real blockbuster. And I think all of these are going to be up there. Most of these bigger than that, and all in just one quarter. You got a Wicked movie coming. You have the next Joker movie coming. Those have been really huge, and I think there's a lot of excitement about that. You've got a new Karate Kid movie, a Karate Kid sequel coming for my generation. I have a feeling, in a way, not anywhere near as big as, Top Gun Maverick, but you could see that my generation and kind of the generation before me really showed up for that, because we've got a lot of nostalgia. We've got a lot of emotional connection to some of these stories, and we're going to be coming back to those. And then there's new audiences coming. So I think that'll be big. You've got Smile 2. Obviously, Smile was a smash success. Now you got another one coming. Moana 2. Don't have to tell you how big that franchise is. And The King is coming. You've got Mufasa the Lion King that is going to be just really big. All of these are in Q4. And I'm not even showing you all the rest of the movies we got in Q4, while we've also been expanding popcorn, while, Adam's telling you that Music artists are calling him. We're working out contracts. He full on said in the earnings call, there are contracts being written for more concert movies and more partnerships and distribution. So there are really good things coming. Okay, so just hang on. Do what's right for you as always. But for me, I'm definitely in. So let's just summarize all that, just to show how bright our future is. Movies are coming, guys. I just showed you that, and if I was to show you 2025, it's even bigger, right? So we start really going towards the end of this year. Adam and team said that. We're going to get progressively better as the year goes too, so that'll be nice. Like we've had the worst part of the blip is behind us. January and February were a little rough in terms of the strike blip, and we're just up from here. Popcorn ROI. So we've had the rollout, we've had expansion. I won't be surprised if there's a few new partners in the future, but we start seeing the return and then the market share growth and all that. Tell your friends, tell your family, get some people on the AMC popcorn bus or train or whatever, and make us some money. I think that'd be great. So, my just side note, my 10-year-old asked for it by name the other night. He was like, "Hey, do we have any AMC popcorn in the house?" I was like, "Oh, buddy, of course we do." So, I just gave him some of that right away, and so that's great to see that people actually like it. Kids tend to tell the truth, and my kids don't pretend if they don't like something. So that was good. Distribution expansion, just mentioned that. That's coming. Candy, I won't be surprised if that kind of slowly expands and we start seeing a return on that. ROI, if you don't know, is just return on investment. And so the great news is if we had the upfront investment, returns are coming. That's what I'm trying to say there. Beer and wine rollout. I won't be surprised if we perhaps see that in the year, although Adam has not said that. So that's perhaps hopeful thinking on my part, but we'll see. It's coming at some point. He talked about in a longer term view, that's why this says longer horizon, expansion of premium screens. Now, if you have seen how much more money we make on those than on some of the other screens, you know why I'm excited about that. That'll come later when we really have positive cash flow, I think, is what he's saying, or at least when he's very confident we're sort of past the storm of the strike and he has plenty of cash, because that will take some investment, but I believe that'll be worth it. AMC is clearly the market leader on premium screens, and I think he has plans to keep us there. And then, you've heard me say this is opinion, but Adam did say it in the call as well, so I think he's backing that up. I have zero concern, over the 2026 debt that's due. You will continue to see on whatever platform you're on, Reddit, YouTube, I see it on Twitter. The shorts will try to put that in your face. That is the biggest amount of debt that's due, is basically due in 2026. But I just have no concern over that at all because he's going to refinance. We're profitable and the balance sheet is healthier than it's been in a long time. And the banks will be looking for a partner. They will be glad to have someone who wants to finance with them. And so, one of these days he'll just say, all right, that 2026 debt has become 2030 or 2032, or I don't know what number, but I do believe that's not going to be a problem to push out. And so I have no concerns over that. And as always, my point of view. We will win. Let's go.